Comments made on the following paid commercial program are an expression of opinion only and should not be construed in any matter whatsoever as recommendations to buy or sell any financial instrument at any time.
Welcome to the Money and Wealth Show. On the program this week, tax tips with David Ingram, money commercials, and with a look back at 2010, our special guest this week is Scotiabank's chief economist, Warren Jestin. Welcome to the Money and Wealth Show. I'm Sterling Fox, and our special guest to help us take a look back on this last program of ours for 2010 at the year is the Chief Economist and Senior Vice President of Scotiabank. It's a real pleasure to welcome Dr. Warren Jestin back to our show. Hello, Warren.
It's great to be back.
Good to have you with us. I checked my notes, and the last time you were here was in May, and it's been a very tumultuous 6 or 7 months since we last had a chance to assess the scene in Canada. But here we are now with just a couple of weeks left on the calendar year. What's your take on 2010?
Well, it's been a great adventure in many ways, and even since May, there's been huge changes. We've gone through the European crisis, learned a whole lot more about Greece and Ireland and Portugal and Spain, probably more than we ever wanted to know, at least about their problems, and the markets have gyrated wildly. But at the end of the day, the type of view that we had back then about the economy slowing towards the end of the year and doing it again next year so that we end up growing less next year than this year is something that we still maintain. That we had a big burst of growth at the beginning of the year because of inventory reaccumulation, fiscal thrust and low interest rates, and as we go into next year some of that dissipates and we end up with the type of growth profile that's somewhat weaker than we would normally expect coming out of a recession.
One indicator, certainly on a global basis, of uncertainty by people all over the world is the price of gold, which in this year 2010 has risen rather sharply. Has that surprised you, or were you anticipating that all year long?
Well, fundamentals of gold are much better than they were 3, 4, 5 years ago. First of all, central banks aren't selling gold anymore, and last year China, Russia, and India bought gold and added to the momentum. The US dollar going down is always good for gold because it tends to push people into alternative currencies. China and India are big purchasers of gold, and as the income goes up in those economies, you would expect more fundamental demand. But in general, with the type of extraordinary volatility we've seen in the markets and the uncertainty out there, gold is a natural winner. It seems to do that when there's uncertainty, particularly in currency markets and in financial markets in general.
One thing that you've just mentioned, the fact that China has been purchasing gold, significant quantities of bullion in 2010, and not really making much of a big deal about it, probably not to allow the price to get even more out of control than it has over the year. What was the reasoning, do you think, behind China's decision to acquire considerably more quantities of gold than ever before?
Well, a lot of countries have enormous investments in US dollars, in US treasury bills and bonds. And I think increasingly you're going to find those economies looking for alternative investments. The Chinese government in foreign exchange reserves has $2.6 trillion. And as you think about that enormous amount of money being diversified into things, perhaps Canadian dollars, perhaps into things like gold, or even into sovereign wealth funds that are buying investments around the world, inevitably that causes the things that they're buying to be bid up in price, and of course the things that they're buying less of to suffer. And that's one of the reasons why I would expect that U.S. bond yields and the like tend to go up over the next few years, because there's less fundamental demand as people diversify their portfolios.
The Bank of Canada, within the last couple of weeks, issued an interesting warning for us Canadians, saying essentially that if there is another global economic crisis similar to the one that we've just been through, and God forbid we should have to deal with it again, but if that should come about, Canadians are not in the least bit immune from the negative effects of such a crisis. And they point to Europe as being the likely source of that trouble. Do you agree?
Well, Europe is one source because the financial difficulties, the fiscal difficulties that are there aren't going away anytime soon. So you can find that they will do a deal to paper over the type of debt refinancing that is needed over the next couple of years. But at the end of the next couple of years, unless some pretty fundamental fiscal changes have been made, the issues are still there. And I think you're going to find over the next year particularly that Europe will come back to haunt the markets going forward. In Canada, we've been special in a number of ways. We've got the strongest banking system in the world. We've got a fiscal situation that is much worse than many other countries. But there are some issues that the Bank of Canada has pointed to. The first thing is that household debt levels relative to disposable income have never been higher.
Right.
And in fact, as Americans have paid down debt and Canadians have still borrowed because our employment has been strong, our real estate markets have been strong, we've actually risen a little above the U.S. But let's be clear about this. Canadians have very strong assets on their balance sheet as well. And our financial condition in general is much stronger, in my view, in the household sector, in the business sector, and in the government sector. So if there is another financial shock out there, yeah, we're going to get hit too. But I still think we have insulation that some countries, such as the UK or the US, simply don't have.
Banking question for you. You've talked about the European situation, and whereas in Greece the government essentially was broke, in Ireland, the most recent European crisis spot, the banks are essentially broke. Would a bank like Scotiabank or any of the other big Canadian banks be interested in going into Ireland and buying up assets at a premium?
Well, I think you're finding that Canadian banks in general, Scotiabank certainly, has been out there investing abroad. But we're very careful about what we're investing in.
Right.
And it really depends longer term on how those assets will perform. Right now there's still a lot of uncertainty in the Irish banking situation. A lot of the investments are made in markets that are pretty unsettled. And that's why the government has been called on to really finance a large part of the problems that exist there. And I think those problems are going to persist for a while. So we're looking at alternatives, but where we've been looking has tended to be in Latin America or in Asia, where we're comfortable with the markets, where we've been for a long period of time, and where we look for a good rate of return for our shareholders.
Didn't Scotiabank in 2010 buy into a banking system in Peru?
Yes, we've been in Peru, Chile, and a wide variety of other countries that actually have pretty strong balance sheets and excellent growth prospects.
So even though the Irish banking situation may look attractive on paper, because of the high risk associated with that, Peru and Chile are, by comparison, much safer places to invest for a Canadian bank.
And in fact, if you look at where we were 10 years ago, something has very fundamentally changed here. The Greeces and the Irelands and the Portugals are seen as developed economies and more stable, but also because of very high debt, they now look vulnerable, whereas countries like Peru and Chile, and I could name a large number of other so-called emerging economies, they're looking more attractive. They have less debt on board, they have stronger growth fundamentals, and effectively within their economy as well, there's some very vibrant opportunities.
Our guest this week on the Money and Wealth Show with our look back at 2010 is the Senior Vice President and Chief Economist of Scotiabank, Warren Jestin. Lots more ahead. Please stay with us.
Hi, I'm Larry Ray, President and CEO of American Manganese, Inc. Our project in Arizona is electrolytic manganese. We have a resource of 11 billion pounds, currently trading at $1.40 a pound. Our cost, 44 cents. For more information, go to our site at americanmanganeseinc.com or phone me direct at 604-531-9639.
Welcome back to the Money and Wealth Show. I'm Sterling Fox in conversation with Warren Jestin, Chief Economist and Senior Vice President of Scotiabank. Mr. Jestin visiting from Toronto. And let's talk about your hometown and Vancouver, Victoria in terms of real estate as we wrap up 2010 with your capable assistance. What about these two high-priced major Canadian real estate venues for 2011? Any corrections in the market? We talked about this 6-7 months ago, and you said, yeah, likely, and we have had some. Is that likely to continue in 2011?
Well, you're going to see two things driving the market. First of all, how's the economy? Both economies are going to be growing. although our bet is that the lower mainland is going to perform better than southern Ontario in general as we go forward. The second thing is the demographics, and the demographics remain very, very strong in both areas, but the relative shift will probably be to the west on the migration side as well. So that I think the fundamentals underlying the market remain stronger here if you're comparing those two market spaces. In Ontario, there has been relatively a good bounce back this year, but on a go-forward basis, there's still a lot of restructuring going on. The Ontario economy is still oriented towards the U.S. market overwhelmingly. Out west, of course, you're oriented towards a market that is growing much more rapidly, more diverse export situation, and one that really benefits from growth, particularly in Asia. So if you're looking at the fundamentals underlying the market from an economic perspective, they remain stronger here. That said, could we have a further correction in the market? Yes, we've been very strong for a long period of time.
Right.
Global activity is slowing a little bit next year. We don't think there's a double dip, but it's going to be slowing. And as that happens, the rapid increase in prices that occurred early on in the recovery phase may reverse a bit. Do we have a bubble? Not at all. I think that the correction stays quite limited and in fact doesn't drive prices much lower than they've been within the last year or slightly more.
I've been trying to count the number of times you've used the word uncertainty already in our conversation, but it is the buzzword of the financial sector the world over these days. There is so much uncertainty. What needs to happen to bring that tension and that global uncertainty and what our finance minister here in Canada calls a fragile global economy more in line, settle it down a little bit? What has to happen?
Well, I think we get rid of the fragility as we go forward, as a number of the debt problems are worked out in Europe and in various other countries as the U.S. comes to grip with their deficit. But we're talking periods of years. This doesn't happen in months or weeks.
Sure.
But the one thing that is different this time around is that the global geography, the economic geography, has changed profoundly, where we have emerging markets, China in particular, driving economic activity in a way it never has before. And so we're going to be living with uncertainty, in other words, unfamiliar market opportunities on a go-forward basis in a way that we never have before the recession began. And that's going to continue over the next decade as this economic geography is rebalanced.
Are you finding more Canadian investors, both private and institutional, coming around to that new playing field that you just referred to, the fact that there are economies like China and Brazil out there that are simply outperforming our own, and we'd better really plug into those marketplaces if we want to go forward successfully?
Well, most Canadian investors are pretty cautious, and we all have a home country bias in terms of what we put our money in.
Sure.
But if you're looking at investments in general, right now the tendency is to find industries or firms that are big global players and bet on whether they're going to be strong continuously in those markets and invest in those particular firms. What's going to happen over the next 5 to 10 years is many of the big global players aren't going to be U.S. based or Canadian based. They're also going to be based in Korea, or they may be based in China, or they may be based in India. And that creates a whole lot of uncertainties out there. We have yet to deal with the fact that many of the opportunities are global and build that into our investment horizons. I think that will be something that creates a lot of uncertainty, but also opportunity over the next decade as this big change occurs in the global marketplace.
Okay, and beyond opportunities out there in the global marketplace, where do you see, looking around the corner to 2011, Warren, opportunities here at home in our marketplace?
Okay, when I look across the country, we think that Western Canada, BC, Alberta, Saskatchewan, and Newfoundland will tend to be at the top of the growth charts. And even though growth may slow down a little bit, it will still be above the national average.
Okay.
And that's because commodity prices, in our view, will remain relatively strong. Natural gas is an important exception to that. But if you're looking at copper or coal, if you're looking at oil, it tends to remain pretty well bid, because even though China slows down a little bit, its growth is going to be 9.5% or so,
Sure.
and India's maybe 8.5%, Brazil's maybe 5%. So there's an inbuilt demand for commodities that tends to keep prices very, very attractive and markets relatively firm. In Ontario, of course, depending on the U.S. market space, it's much softer, and there's a big restructuring going on in manufacturing. When we look at the opportunities too, it's in servicing industries that provide infrastructure, that provide the equipment and the like to rapidly growing markets. There's enormous opportunities there. And it's not only manufacturing or mining, it tends also to be the service industries themselves because they have the expertise. So I think there's a lot of opportunities, but the opportunities in many ways are directed either directly or indirectly outside the country and to emerging market growth.
Is it still tough for startups in Canada to get venture capital from the banks?
Well, the banks aren't in the venture capital business. Banks are into lending in a way that tends to keep risk within the tolerance levels not only of our regulators, but also of our shareholders and our depositors, because the banks typically do not go into high-risk areas. Venture capital is coming back, and you're seeing it in the marketplace in certain important areas. But the whole restructuring of the financial system globally has tended to lead to a bit of a setback in that area because people have less risk tolerance than in the past. They've been through the ringer in the last 2 to 3 years. They've seen what risk does to their investments, and they've tended to pull in. Do I think that's going to change a little bit? Yeah, I think investors will become a little bit more risk tolerant as we go forward, but it'll happen in waves. Average Canadian investor, for example, might decide to take on a little bit more risk, and then all of a sudden the headlines focus on Greece or Portugal or Ireland, and they say, well, gee, maybe there is still too much risk, so they pull back. The improvement in risk tolerance that will happen over the next 2 to 3 years will be gradual, it will tend to be sporadic, and we will have market setbacks along the way.
Our special guest this week on the Money and Wealth Show, Senior Vice President and Chief Economist from Scotiabank, Dr. Warren Jestin, with us. And we're back with more after this message.
Hi, I'm Larry Ray, President and CEO of Gold Ray Resources Corp. Our major project is in Shandong Province, China. It's a gold project with a 43101 resource. We're currently negotiating a $16.5 million US loan to take it into production at 1,500 tons per day. For more information, go to goldray.com or phone me directly at 604-531-9639.
Welcome back to the Money and Wealth Show. I'm Sterling Fox. Our guest this week, Warren Jestin, back with his second appearance on the program from Scotiabank headquarters in Toronto. And thank you, by the way, for arranging to have your headquarters in Vancouver available to us for this interview today, Warren. We can't do a year-end conversation at the end of any year in Canada without paying some attention to the next-door neighbors. We saw Ben Bernanke on 60 Minutes a couple of weeks ago talking about quantitative easing, the second round of which is well underway, and alluding to the fact that they may be a third round coming. These people are printing money, it seems, indefinitely. First and foremost, do we do that too?
No, Canada hasn't been caught in that trap, and in fact, the Bank of Canada has been very cautious not to follow that particular route. We've raised interest rates 3/4 of a percentage point this year, so if we had to provide some more monetary easing to get the economy going, providing a monetary goose to the economy, we could actually take those rates down again. In the U.S., effectively, the rates are zero, so you have to come up with something else, and that something else is quantitative easing, or as you say, printing money.
Right.
And we've done it once, we're doing it twice, and in fact, there's even been a hint that if the economy doesn't pick up, there'll be a more aggressive policy putting in next year. What that effectively does is go out, the central bank is going out and buy U.S. government bonds, which hopefully keeps those rates down. But the announcement a couple of weeks ago that Obama was favoring a much more substantial fiscal stimulus package, and that was actually approved on a go-forward basis, has got bond investors nervous. Because what they see happening is printing money, big fiscal stimulus, not addressing the problems that we have today, which is big U.S. government deficits, $1.3 trillion this year. All of those things coming together to give us good news today, but having bad news 2 years from now or 3 years from now. And so we've actually seen longer term interest rates in the U.S. rise over the last few weeks, and they've risen to a level that suggests that investors are now saying, gee, these policies just can't go on forever.
So if they can't, and Mr. Obama and his team of advisors seem determined to make them go on forever anyway, what's the remedy, Warren? What would a banker suggest to the president, given a moment of time with him, to get the heck out of this debt hole, which printing money seems to be analogous with simply digging deeper?
Well, the first thing is, before the presidential election, which is 2 years away, I doubt whether anything meaningful is going to be done.
Okay.
We'll see some shifts, tax policy changing to help support the economy and the like. But in the here and now, I don't think there's going to be some major changes. You don't have to ask a banker how to solve these problems. The average person on the street knows that if you've got you're spending vastly more than you're bringing in and you're ranging up big debt, the tough decisions have to be made. And they are made on the spending side, or from the U.S. government's perspective, eventually having to raise taxes. My bet is that within the next 5 years, the U.S. is going to have to resort to significantly higher taxes in order to bring in the deficit, because while they can bring spending down, military spending down, for example, the big growth in spending is healthcare. And we've got a baby boom generation galloping towards retirement, and those healthcare dollars are going to be required in ever larger numbers. So the U.S., how do you get out of it? Well, near term, I don't think they're focused in on that because they want to get the economy going. On the medium term, with healthcare spending likely to rise, Social Security likely to rise, they're going to have to raise taxes.
And the reason we have to pay attention to the United States is they buy 75% of everything we make in this country, and we're just utterly dependent on their economy. And as time goes on, Warren, we're less and less comfortable with that, which is why, as you've already pointed out, Western Canadians have been really working hard to diversify their economies away from dependence on the U.S. for quite some time now.
And in fact, BC is less dependent. The most dependent province is Ontario, and that's one of the reasons why we're expecting slower growth going forward. It's oriented towards a market that's going to be growing at a slower rate, whereas BC is focused on, first of all, more diversified, but also focused on much faster growth markets. If you look at the U.S. performance next year, it's probably going to be stronger than in Canada, because of course they're giving a big fiscal goose and they've got interest rates at lifetime lows. In Canada, the federal government has already indicated they're going to be pulling in the horns to try and get their deficits down. Every province is also focused on reducing deficits. The economy is stronger here, so we have the luxury of being able to do that. Moreover, I think the average person wants it done now because we've been through the fiscal ringer in the 1990s. We don't want to go back there again.
Back to investment possibilities for a moment or two. We talked about gold and the amazing rise in the price of gold beyond the affordable range of most private citizens. But some of us like to buy gold mining stocks. Given the popularity of gold and the likelihood of that to continue, are Canadian gold mining companies something to keep a sharp watch on?
Well, you never ask an economist a question involved with investments or any real world type of question like that. But I'll give you my views on the fundamentals here.
Okay.
I think you're going to see on a go-forward basis that the fundamental demand for gold is going to rise significantly as incomes go up in emerging economies. But you're also going to find that the demand for coal is going to be going up as industrialization proceeds and development proceeds in countries like India and China.
Sure.
You're going to see the demand for iron and copper and metals increase significantly.
Potash, too.
And potash as well, because potash, of course, fell spectacularly in price as global investors stepped back because they were a bit shocked at how fast potash had gone up. We're going to find commodities in general across a whole spectrum doing very well. The big issue is, have the prices of those stocks been bid up too much? We've had a big run, and there's probably going to be a pull-up back, but from an economist perspective, where the most favorable economic circumstances will lie over the next little while is in industries that are focused on the rapidly growing economies. Mining is one of them. Oil tends to be another one. Service industries that are focused on engineering and infrastructure will be another area as well.
As far as priorities, as we look around the corner to 2011, and we all do our resolutions one way or another, I would think probably at the top of every indebted Canadian's resolution list, Warren, ought to be to reduce that level of personal and/or household debt.
Well, at least bring the debt down to levels that you would be comfortable with if interest rates rise.
Okay.
I mean, if you think that interest rates are at normal levels right now, you are suffering from delusional thinking. Look at low interest rates now as a gift, and that gift is going to go away over the next 2 to 3 years. You want to make sure that you can stand an increase in interest rates of 1-2 percentage point, maybe not over the next year, but as you go through the years after. You have to have a strong balance sheet in the type of uncertain markets we're dealing with right now.
An important bit of advice to end our conversation. Mr. Jestin, good to see you again, sir. We appreciate your joining us again for your second visit in 2010 and for giving us the opportunity to wrap up the year from the perspective of a senior Canadian banker. And we'll be right back.
Hi, I'm Larry Ray, Chairman and CEO of Molycorp Gold Corp. Our major project in Nevada is magnesium. We have a 43101 resource of 52 billion pounds at $1.30 a pound. Do the math. Go to our website at molycorp.com or phone me direct at 604-531-9639.
Tax Tips with David Ingram.
Gambling. You're a Canadian. You won $1 million, $2 million, $17 million on the lottery. Not taxable. But you also may be somebody that just plays cards for a living. That's what you do. We just had a situation where we sent in a check for over $25,000 to a man that does exactly that. He'd made just about $100,000. We calculated his tax out. It was $25,000. And he was happy to pay it because as far as he was concerned, his job was gambling. Revenue Canada sent it back. That's right. Revenue Canada, the CRA, sent it back. They said gambling's not taxable in Canada. So that's the rule. Whatever you win, not taxable. But if you win it in the States, they're going to withhold 30% tax and it might not be recoverable. That's a tax tip.
And that's our program for this week. Our thanks to David Ingram and to our special guest, Warren Jestin. And thank you for joining us. We always appreciate hearing your thoughts about the program. If you have some, send them along to us. Comments at themoneyandwealthshow.com is the email address. And on behalf of Tom Allen and the entire crew, thank you so much for joining us in our first year. I'm Sterling Fox. See you next year.
Comments made on the preceding paid commercial program are an expression of opinion only and should not be construed in any manner whatsoever as recommendations to buy or sell any financial instrument at any time.